That motivated seller listing you just saw? Odds are it's a lie. In 2026, real estate agents and wholesalers are still slapping that label on properties, but the data tells a very different story. We're seeing record low genuine seller motivation, the lowest in a decade, according to multiple analysts. Even distressed homeowners are now getting identical outreach from dozens of investors, turning their motivation into just another commodity. So, while everyone's chasing these phantom deals, they're missing the actual market dynamic. I'll show you why these motivated sellers are often overpriced, and by the end, you'll see exactly how much this hidden dynamic is costing you. The number is bigger than you think. Forget what the gurus are telling you about a flood of motivated sellers in 2026. The data shows genuine seller motivation is at its lowest point in a decade. We're not seeing the distress levels that lead to deep discounts. Instead, we're seeing an ecosystem where every distressed address instantly receives identical, lowball outreach from a dozen investors. This isn't a buyer's market for deals. It's a feeding frenzy where the real motivation is on the buyer's side, not the seller's. Consider the landscape. With mortgage rates hovering in the low 6% range, as Freddie Mac reported averaging between 6.11% and 6.64% in early 2026, the lock-in effect for many homeowners is still very real. People who refinanced into 3% mortgages aren't eager to give that up. This creates a supply squeeze. Even as the Open Door editorial team noted, the market is stabilizing. Without a significant external shock, the motivated seller you're looking for simply isn't there, or they're so inundated they've become resistant to any offer not at or above market value. We're going to break down why this perceived motivation is often a mirage and how that's tricking buyers into overpaying, especially in markets like Phoenix and Tampa. Why is it that genuine seller motivation is at its lowest point in a decade, yet motivated seller tags are ubiquitous across every investor forum and direct mail campaign? The reality is, despite the relentless marketing hype, finding a truly distressed deal in early 2026 is like chasing a phantom. As of late 2025, Spencer Sutton, a noted real estate analyst writing for the Evernest blog, succinctly highlighted that American homeowners are particularly unmotivated to sell, with national inventory hovering near historic lows, down 20% from pre-pandemic levels. This isn't just an anecdotal feeling. It's a direct, measurable response to a climate of stubbornly high interest rates, elevated asking prices that most buyers, facing 7% plus mortgage rates, simply can't stomach, and a significant 15% year-over-year slowdown in sales activity. Consider the homeowner who locked in a 3.25% fixed-rate mortgage on their Frisco, Texas, home in 2018. Why on earth would they sell now, only to face a 7.5% or 8% rate on their next property? The equity they've accumulated is substantial, but the cost to move up or even move sideways is prohibitive. Data from the National Association of Realtors shows over 60% of current homeowners have mortgage rates below 4%. Most people simply won't sacrifice that financial advantage. This creates a scenario where the few homeowners who might consider selling due to genuine distress, perhaps a job relocation or a sudden medical emergency, are immediately swarmed. We're seeing this play out acutely in metros like Atlanta and Phoenix, where a property hitting a pre-foreclosure list instantly becomes a high-stakes commodity. That single address, often within hours, receives identical, lowball outreach from a dozen or more different investors and wholesalers. The market for what used to be a genuine deal is completely saturated, not by end buyers, but by the opportunistic, undifferentiated noise from other investors. This isn't a market brimming with desperate sellers. It's a market where everyone thinks there are desperate sellers, leading to an oversupply of identical, often unsolicited, offers for the vanishing few truly motivated individuals. So, where did all the actual homes go? So, if genuine seller motivation is at a decade low, why isn't more housing hitting the market? It's not just a lack of distressed sellers. The entire supply chain for new and existing homes is fundamentally stalled. Jake Krimmel's January 2026 Housing Market Trends Report, released February 5, 2026, highlighted a critical point. Nationwide housing inventory recovery has essentially flatlined. We saw active listings rise only 10% nationwide compared to the previous year, a decelerating rate that screams tightening. For context, December 2025 saw a 12.5% year-over-year increase, indicating a clear slowdown in new listings arriving. It's an illusion of recovery. Lance Lambert from Resi Club, in his March 6th analysis of February 2026 data, noted that U.S. housing market inventory is up 8% year-over-year through February 28, 2026, but he stressed that this rate keeps decelerating. This mirrors what we saw in 2024, where early year increases gave way to stagnation. Think about it like this. If you're seeing 10% more widgets on the shelves, but the rate at which new widgets are arriving just plummeted from 15% to 8%, you're not out of the woods. It's the same in housing. Even in places like Canada, the CMHC's Housing Market Outlook 2026, published in December 2025, projects that while resale markets will show recovery signs in regions like Vancouver and Toronto, they'll remain below long-term averages. Critically, housing starts are expected to slow even further, with a projected 5% decline in 2026 after a 3% drop in 2025. So, fewer new homes are coming online, and existing homeowners are hunkering down, with data from Redfin in late 2025 showing that American homeowners, particularly those with sub-4% mortgage rates, are unmotivated to sell. This isn't just a lack of distressed inventory, it's a choked pipeline at every stage. But if homes aren't moving, what exactly is comprising the inventory we are seeing online? But if actual distress is low, why does it feel like there's more inventory? This is where the concept of phantom inventory comes in, and it's actively misleading many prospective buyers. While overall inventory has shown some recovery, the critical nuance, as Lance Lambert highlighted for Resi Club on March 6, 2026, is that this rate of increase is significantly decelerating. We're seeing fewer new listings hit the market each week than we were a few months ago. So the total count might be up, but the flow is slowing. A substantial portion of what appears to be available inventory often isn't truly available for new offers. Think about it. Many listings you see online are actually pending. The Open Door editorial team, in their May 18, 2026 update, detailed how these properties, once an offer is accepted and major contingencies are typically satisfied, are off the active market for anywhere from 2 to 8 weeks. They're still showing up in some aggregate inventory counts, but you can't make an offer. It's like seeing a for sale sign on a home where the closing date is already set. You're seeing it, but it's not a deal you can pursue. And looking ahead, new supply won't be picking up the slack. The CMHC, in their recent Housing Market Outlook 2026, projects a more significant decline in housing starts for Canada this year. Even with some signs of recovery, they expect Canadian resale markets to remain below long-term averages in 2026. This isn't just a Canadian issue. It's a structural challenge in many developed economies. So, we have a decelerating increase in existing homes. A large chunk of those existing homes are already effectively sold, and new construction isn't coming to the rescue. This creates a perception of choice that just doesn't align with the underlying liquidity in the market. But what about mortgage rates? Aren't lower rates supposed to unlock more sales and bring down prices? But why haven't mortgage rates, now in the low 6% range, sparked a price correction? Despite Freddie Mac reporting 30-year fixed rates averaging between 6.11% and 6.5% as of early 2026, according to the Open Door editorial team on February 12, this stability hasn't translated into a surge of motivated sellers or the significant price drops many buyers are anticipating. You'd think even a slight dip from peak rates would push more inventory onto the market, right? The reality is, most homeowners who would consider selling are still locked into rates from years past, often in the 2 to 4% range. Giving up that low payment for a new mortgage in the SIXS just doesn't make financial sense, even if it's a few points lower than it was a few months ago. Spencer Sutton, writing for the Evernest blog on December 7, 2025, highlighted this unmotivated to sell phenomenon. The expectation of continued high asking prices, coupled with the pain of sacrificing a lower rate, is a critical factor keeping these potential sellers on the sidelines. Imagine a family in Tampa who refinanced in 2020 at 2.8%. Even if they've outgrown their house, moving to a new property with a 6.2% mortgage means their monthly payment could nearly double for the same principal, effectively trapping them. Graham Stephan, in his January 19, 2026 article, "Mortgages Are Falling, But I'm Selling Everything," reinforced this, asserting that lower rates won't automatically lead to housing deals. This creates a peculiar dynamic where buyers are waiting for prices to drop, sellers are waiting for rates to drop further, and nobody's making a move. It's a standoff, and the slight wiggle in mortgage rates isn't enough to break it. But if rates aren't the catalyst for more inventory, what about those homes that do come on the market, the ones advertised as pre-foreclosures? And this is precisely why that elusive, motivated seller deal you're tirelessly searching for is, in almost every measurable way, a mirage. Pre-foreclosures, historically the prime hunting ground for investors seeking deep discounts, are currently at historically low levels, effectively rendering this traditional source of truly motivated sellers non-existent. Consider the data. The Open Door editorial team, in their comprehensive market analysis published on June 22, 2026, explicitly highlighted the staggering 78% decline in new notices of default, NODs. Lenders were actually filing compared to pre-pandemic averages. This isn't the chaotic market of 2008 or even 2011. The current low default rates, hovering near 0.5% nationally according to the Mortgage Bankers Association's Q4 2025 report, indicate that homeowners are largely managing their mortgage obligations with remarkable resilience, thereby preventing the anticipated flood of distressed properties many are still waiting for. Even in the rare instance a genuine pre-foreclosure does arise, for example, a notice hits public record for a property in the Chandler submarket of Phoenix, you're not gaining an exclusive lead. That very same address, often within minutes, is receiving identical outreach from a dozen different investors, direct mail pieces from We Buy Houses companies like OfferPad and Zillow Offers lookalikes, and relentless cold calls. Spencer Sutton, in his detailed market insights for the Evernest blog on December 7, 2025, underscored that genuine seller motivation, the kind that translates into significant double-digit discounts, is at its lowest point in over a decade. These aren't just unmotivated sellers. These are homeowners frequently locked into sub 3.5% interest rates who simply don't have to sell, regardless of how much pressure they receive or how many letters land in their mailbox. So, that elusive, motivated seller deal you've been chasing with such fervor? That's the real trap. It's the invisible tether that keeps prospective buyers paralyzed, perpetually waiting for a market event that the most current and robust data, right now, simply doesn't support. So what does all of this mean for the motivated seller you're still chasing? It means the playbook from 2008, or even 2018, is simply not applicable to 2026. This isn't a market where you can reliably find deeply discounted distressed assets when national inventory is flatlining. Mortgage rates aren't forcing sales, and pre-foreclosures are at decade lows. The perceived surge in available properties is largely a phantom, and those lower rates aren't unlocking the locked-in effect for homeowners with sub-4% mortgages. You're not up against widespread distress, but rather a persistent supply shortage exacerbated by the lock-in effect. Have you adapted your investment search, or are you still relying on traditional motivated seller tactics? Share your strategy and what you're seeing in your local market like Boise, Tampa, or Seattle down in the comments below. If you want more data-driven insights like this, hit that subscribe button to keep your investment thesis sharp. And if you're trying to understand the ripple effect of Florida's insurance crisis on property values, watch my breakdown of how that's shifting capital in the Southeast next.